General Mills is down by 27.4% from its peak in May 2023, so just 6 months ago. Thanks to that, it may be the right time to invest in one of the biggest food companies in the US. General Mills produces baked goods, cereal, flour, snacks, meals, and many more. Some of its top brands are Cheerios, Cocoa Puffs, Betty Crocker, Old El Paso, and it also produces my favorite ice cream, Häagen-Dazs. When we look at the recent results, it's getting pretty obvious why the stock is down. Even though the revenue is up by 4% year over year, net income is down by 17.3%, cash is down by 16.6%, and the debt is up by 5.6%. That is not exactly great. If you were to invest $1,000 into General Mills 10 years ago, you could buy around 21 shares, and today they would be worth $1,380. But let's not forget about the dividends. Through the 10 years, you would receive $408 as dividends. So if we add together the current value of shares and the dividends, we get $1,788. So that is a gain of 78.8% in 10 years. That is very nice, but past results are not necessarily the best way to predict the future. So let's analyze and value General Mills to really see, is it a good investment opportunity? Individual insiders, that is an X. Only 0.2% of the company is owned by individual insiders. And we would like to see this number over 2%. So the management does not have its skin in the game. And are individual insiders buying? That is an X. We see only sale transactions in the last year. And do super investors own this company? That is a check with one super investor, and it is Jensen Investment Management. But it's worth noting that it makes up only 0.06% of the portfolio, so it's not a major position. And are they buying right now? That is an X. Jensen Investment Management reduced its position in Q2 2023 by 6%. And at the same time, Lee Ainsley closed his position altogether. Return on invested capital, that is a check at 10.3% 10-year median returns. And we want to see this number higher than 10%, so it just made it. And free cash flow growth, that is an X at minus 1.1% 10-year compound annual growth rate. So unfortunately, this is a red flag. And what do we know about the net profit margin? It is a check at 12.1%, and the industry average is 7.1%. So a very nice margin. It seems that they are making the most of their status as one of the largest companies in this industry. And now let's take a look at share buyback. It is a check with 10% of shares bought back in the last 10 years. That is very nice. It is not an aggressive share buyback, but a meaningful one nevertheless. Now, let's take a look at the debt. It is an X. It would take 5 years to pay the long-term debt with a current free cash flow. And we would like to see it under 2 years. So that is another red flag. Such debt can become a problem, especially in this new environment of higher interest rates. The dividend yield is 3.6%, so shareholders should get $2.36 per every share in the next 12 months. That is a nice dividend yield. And of course, it got bigger thanks to the recent drop in price of the stock. And the payout ratio? It is an X at 51.6%, and we want to see it somewhere between 20 and 50%. So it is just over that, and I would not be too strict about it. It seems like a pretty secure dividend, and I don't see any real reasons for the dividend cut in the near future, especially when we look at the dividend growth. It is a check at 2.9% 5-year growth rate. And when we look at the history of this dividend, we see that it was not going up every year, but it never went down. So that should give us some confidence that the dividend will continue to grow in a thoughtful and secure way. Price to earnings ratio is 16, so it's substantially lower than the S&P 500 average, which is 24.6. But that is a very simplified way of valuing a stock. We will use a discounted cash flow formula and we will estimate the growth of General Mills for the next 10 years. And because predicting the future is not the easiest thing in the world, we will make 3 possible scenarios of this growth. So in the low scenario, we will estimate a growth of 2% for the first 5 years and then 1%. In the medium, 4% and then 3% growth. And in the high scenario, 5% for the first 5 years and then 4% growth. Now, why did I use such estimates? Well, analysts predict that the food market between 2023 and 2028 will grow at an annual rate of 3.4%. So that is basically our medium scenario. Low scenario shows a situation in which the company is doing worse than the market, and the high scenario predicts that General Mills will outperform most of its competitors. So with such estimates, the intrinsic value in the low scenario is $27, in the medium scenario $34, and in the high scenario $37. But we have to also add a margin of safety. The bigger it is, the safer the investment. I use a 30% one and it gives me this extra room for mistakes that makes me feel comfortable. So with such a margin, we get in the low scenario $19, in the medium $23, and in the high one $26. And the current price is around $65. So it is all in the red. This company is currently quite expensive. So it seems that the drop in price is not actually a bargain, but a correction, which gets the price closer to the intrinsic value. What is a big benefit in this price change is, of course, a bigger dividend yield. So if you are a dividend investor, it may create an interesting opportunity. But let's not forget about a declining free cash flow and a very substantial debt. If you enjoyed this video, you may want to check out my analysis of Cal-Maine Foods by clicking over here. Thank you so much for watching and see you in the next one.